Hi, today I'm introducing New Haven Mortgage Income Fund. New Haven currently manages approximately $165 million in mortgage, primarily in residential mortgages across Ontario. It offers a monthly income program, or you can reinvest your income for compound growth. I'm here today with Arjun Saraf, CFO. He's going to share his company's insights, the process that they use, and talk a little bit about New Haven for us. Welcome, Arjun. Thanks for taking the time.
Thanks for having me here, Cynthia. Great to be here.
So, since 2009, you've grown to $165 million in mortgages. Can you talk a little bit about your growth plan and how you've grown to this size and why you've sort of taken the time to build your business the way you have?
Sure. Compared to some of our counterparts, we haven't grown as quickly or as exponentially. We've done it in a systematic way, majority through organic growth until about the last 5 or 6 years. As the industry has matured, we've also participated in that maturation by expanding our operations, acquiring a credit facility with the TD Bank, and our focus really is kind of systematic organic growth. We want to make sure that we don't grow too big, too fast, and are unable to handle it, because the biggest part of this job is money management and managing any fund, making sure that the yields remain consistent, and ensuring that any issues with the fund are dealt with in an adequate manner, and our ever-changing compliance landscape. Things have changed drastically since 2012, when the exempt market dealing space was really brought into fruition, and now here we are over 10 years later, many things are changing. So our growth is really primarily focused on systematic, organic, and will continue to do so as we go along.
So, in a nutshell, sustainable.
Correct.
So tell me a little bit about how New Haven makes investors money. Presumably, New Haven borrows money and lends it out, and it's on the spread. And I'd just like to understand and explain to our audience, how does it actually work? How do you make money, and how do the investors make money?
So we make money from our management fee. We have a 1.5% management fee. Also, any administrative costs on the loans or the commitment fees on the loans, that's where we make our funds to the management company, New Haven Mortgage Corporation. For investors, prior to the interest rate environment being what it is, a lot of our focus was attaining the spread off our facility with TD. However, as interest rates have gone up and the market's changed, we've really started to focus on lower loan to value, better quality deals that will contribute to our sustainability for the long term. So really it's about return management and risk management. So while we can go out there and try and make 9, 10, 15% for investors, they may not want that because it also sacrifices quality of the deals. In the market that has increased in market share or market size, we really need to make sure that while we stay competitive on the rate side, we also manage our risk.
New Haven acts like a bank. So I'd like to, people I think don't really understand how mortgage investment corporations do their business. And you're like a bank. So can you kind of walk us through your underwriting process?
Sure. I would say we're not exactly like a bank because we don't take deposits in and lend that out. We're really based on the investments from investors. We pool those funds together and lend those out in first and second mortgages. In terms of our underwriting, we're really equity-based lenders. So our bread and butter and our niche in the industry was really built on what the marketability of the property is. Now, as time has evolved and the industry has changed, we've obviously added more factors in, specifically the exit strategy, affordability. We take a look at all those factors, but our base and how we've grown and how we've maintained our success to date has really been assessing what the market value of the property is and what loan to value we will actually go up to in order to ensure that, God forbid, if one of the borrowers don't make their payments, how do we have an exit strategy for ourselves? Now, when I say exit strategy, that's twofold. exit strategy could be for us as the lenders, or for the borrowers to graduate to the next level in terms of trust companies or banks. That's part of our success. And part of what we focused on as the good lender is trying to really be a solution for people to make that next step in the journey. So while they can't get to the banks today, what can they do to get there tomorrow?
Right. Yeah, and that leads me into my next question. I understand foreclosure in the process, but what is a power of sale?
So a power of sale is where we have permission from a court to sell a property. It's a process that involves, if the borrower, as an example, is in arrears, we go through the court system, starting with a statement of claim, and then it ends up in us acquiring the property by the sheriff scheduling an eviction, or if the borrower has vacated the property, we then prepare it for sale, get 2 appraisals, make sure we list it at what's reasonable for market value, and in essence, we sell it on the open market, and any buyer can come buy that, and that's how we recoup our capital and our interest and our costs associated with it. On the foreclosure side, obviously that's a little different, where we end up owning the property, and we rent the property out, we hold on to it for a period of time till we feel that the market value is reflective of a position where we can actually sell it and then recoup all our capital. So depending on the situation, we choose
Right.
one or the other.
Sort of depending on market conditions at the time, because if you can go a power of sale, you don't have property management division, I'm assuming, at New Haven, so you really don't want to be property managing.
Correct, and that's part of the issue is that, when looking at these properties, we have the experience and the expertise to determine, is it worth holding on to this property? We've done the market analysis. Do we feel that we can actually sell this property and recoup our capital 5 years down the line, 3 years down the line? Or is it better just to cut bait now and make that decision?
Right, that makes good sense. In your latest update, I noticed that there was approximately $6.6 million in arrears, in principal arrears, about 4%. What does that mean? And is that within the realm of proper metrics for a mortgage investment corporation?
Now, it's never ideal, obviously, to have any arrears, but in our industry, it is somewhat normal to have a certain percentage within 1 to 5% of arrears. That being said, a lot of why we have arrears today is because we're really focused on trying to find a solution that is appropriate for the borrower. So a loan may be 50, 60 days in arrears, but that also could be because the borrower has listed their property for sale, and we're allowing that to happen. So there's a multitude of factors that go into that statistic. But for the most part, how we are viewing this is the times have changed, interest rates have changed. How are we able to best manage these arrears to exit out of them properly while preserving capital for the investors? And sometimes that involves us taking a period of time to come up with a proper solution, whether we go power of sale, whether we go foreclosure, whether we let the borrower deal with it themselves. And that's all dependent on if the borrower comes to the table or not. So in terms of how we view it in the overall industry, we think it's part of the times. A lot of people are experiencing similar statistics on their portfolio, and we're managing it to the best of our ability like we have for the past 14 years.
Go.
Great insights, Arjun. I've learned a lot in this conversation. Happy that you can share your knowledge and expertise. Let's talk about today, where the market is, where the risks are,
Right.
and then kind of tell me a little bit about how New Haven thinks about the future and some opportunities that it can take advantage of.
Sure. I think today, obviously, with the market the way it is, the interest rate environment, the Bank of Canada obviously just held the key interest rate. So that to me indicates that obviously if there are any potential hikes, it will be minimal, if any at all. Now what that signals for the industry is that there's kind of a bottom in sight for the market, which is very important, especially for borrowers and lenders alike, because then they can assess and plan for the future. What I feel like will happen in the next year, 2 years, is that at some point the interest rates will have to come down because they will still need to spur an activity. The housing market is too critical for Canada in general for the industry not to have as much activity as it's had in the past. So while today people should manage their portfolios, take a look at all the mortgages that are coming up for renewal, assessing what the best plan of action for that is going forward. However, keeping an eye on being potentially liquid for the future and taking advantage of the fact that the market will turn around. The housing market is cyclical, it's always been that way. And be in a position at that time to be able to take advantage of good properties out there and maximize investor returns.
Great. Well, thanks Arjun for taking the time. Great insights. Looking forward to working with your group because I think it's a great yield play for a lot of investors. And thank you. Onward and upward.
Thank you, Cynthia.
Thanks.